Good snowy afternoon, April 21, and the snow is coming down in big flakes here in the woods in upstate New York's Adirondacks. Today we're going to take a quick look at Digital Turbine, the #2 ranked SuperGrowth MultiBagger in terms of strength of financial statement trend. And I'm going to talk very briefly about some of the methodology behind our research. Okay, starting with a risk assessment of the overall market, we'll take a look at the S&P 500. Our risk assessment, fairly high, new purchases, 6% of cash position. We're about a little over 90% in cash right now. Portfolio is up about 7% so far this year. Almost all of that is in the last 3 weeks. I think we ended the quarter up a couple of percent, due primarily to the weakness in tech stocks and pharmaceuticals. A couple weeks ago, we were 93% invested, 7% in cash, so we've been heavy sellers until a couple of days ago when we started to buy. Our risk assessment is based on the proximity of the current price of both the S&P 500 and the 100 fastest growing low debt public companies traded in the US. The closer it gets to the sell at level, where we are sellers on strength and buyers on weakness. So, of course, that only works in high quality companies. So we are buyers when the market is declining sharply and sellers when it's going up rapidly. And it, of course, have gone through a few weeks here of very strong performance. So we were primarily sellers until a couple of days ago. Anyway, the SuperGrowth MultiBagger, well, we'll take a quick look here. So we have proximity to sell at for 4.5%, proximity to buy at 6.8%. So the risk slightly distorted toward the higher risk. Okay, now moving on to Digital Turbine. This is the summary report, and as mentioned before, of primary importance is this middle graph, which looks at 15 different financial strength criteria, including profitability criteria, because of course they affect financial strength. So return on assets by free cash flow, debt levels in relation to both equity and free cash flow, cash levels in relation to total liabilities, interest coverage by free cash flow. There's 15 in total, and we found it to be a particularly meaningful indicator of future stock performance. Looking at the growth charts, top two, revenue and gross profit, bottom, operating free cash flow, pre-tax free cash flow. And here are the numbers. You know, these numbers, for someone like me who looks at lots of different companies every day, they're pretty phenomenal. 23, 23.4, 24.2, 26.7. I would say that somewhere around 3 or 4 public companies have growth trends that are that strong. This company, of course, provides a platform, a kind of an intermediary between the big cell phone companies like Verizon and the marketing companies that want to put ads on cell phones. So they make the whole process, they monitor it, collect the money, remit it, keep, I think, 40%, send 60% to Verizon, etc. And, just explosive growth here. 4 quarters versus 4 quarters a year ago. These numbers are rolling 4 quarters, so that's 4 quarters versus 4 quarters ended 3 months earlier versus 4 quarters ended 3 months before that. But looking at it, 4 quarters versus 4 quarters ended a year ago, over 100% revenue growth, 200% operating free cash flow, 250% increase in return on assets. So this is a company experiencing phenomenal growth, and it just became free cash flow positive a, a couple of years ago. So yeah, exciting situation. Taking a look here at the momentum charts. Same numbers down here on the left, but these are the trends in revenue and gross profit rate of change and overall financial strength momentum. Again, it's rare to see this consistency. You often see very strong trends, but every quarter it seems this company achieves significant improvement. Okay, so we buy these excellent companies on weakness and sell them on strength. A lot of our subscribers just buy them. They're long-term investors. They don't want to sell positions in great companies. There'll be more on that later. I'm going to talk a little bit about our approach and our philosophy around selling, but taking a look at the algo generated buys and sells over the last year or so, you see the algo was a buyer starting in late February, bought all the way down. That's not abnormal. And then began to sell on little bounces, sold on strength, bought, sold. I don't need to go through this, but anyway, you get the general picture. Current indicated buy at $67.24. Indicated sell at $92.99. Stock price was $69.48 at the time this was prepared. We're 3% above the buy at, 33% from the sell at. Average holding period over the last year. Now this is working. This is the pattern the algo is currently working off of. This is not trying to say if you follow the algo you'll make 1,300% over the next 12 months. It's saying that the most profitable pattern over the last year, the one that it's currently using, is that it's using to determine these buy at and sell at prices, is based on this pattern that the algo is currently seeing. All right, so I'm going to spend a couple minutes today talking about our overall investment methodology and research. Our approach is best described as fundamental analysis of financial statement trends, accompanied by artificial intelligence pattern recognition of stock price patterns, such as you just saw in Digital Turbine. I sometimes have problems with names. We essentially view research and investing as probability analysis. The market is driven by three different factors: randomness, people having to buy or sell for reasons that have nothing at all to do with fundamentals; emotion, fear, and fear of missing out; irrational exuberance, fear of losing one's retirement; and fundamental business principles, all three. We've developed software that addresses all three and is designed to capitalize on all three. Taking a look at Netflix, which is the top performing S&P 500 stock of the 10 years ended 2020, you see that it was up 37 times in that period. You see that 5 times it declined more than 30%. The average decline was 47%. Once it declined more than 80%. So this is the top performing stock. And the point is that even the top performing stock of the decade experienced significant declines. That's a fundamental factor or a crucial factor in the process we use to make investment decisions is to capitalize on that. You need to do two things to capitalize on that. One is, of course, you need to be liquid after significant drops. The only way to be liquid after significant drops is to sell after significant price increases. We believe this reduces risk. It does increase overall returns. It does increase the tax bill, but we see it as a fundamental or important, rather, element to risk management is selling on sharp price increases. And the algo is not, because the algo works off of the simple moving average, it's looking for particularly sharp increases and decreases in prices. A gradual decline won't affect it. It needs a sharp decline. And the reason that it's created that way is because it's looking for emotion. It's looking for panic. It's looking for exuberance. You know, a fundamental aspect that this relies upon is the belief that the higher the market goes, the more people want to get into it, the more confident people are, the more they're worried about missing out, you know, the sharper the increase. So it's not driven by fact. It's over the long term, the market's driven by financial statement performance or financial performance as reflected in financial statements. It's driven particularly by free cash flow trends, but it's but in the short term, that has relatively little to do with the stock price. You know, as I said, the stock price is bad earnings report, sell. Good earnings report, buy. And, and of course, you have sellers who need to raise cash for some reason. And that affects, completely disconnected from the financial performance of the company. In any event, whatever it is that drives this volatility around the moving average, our algo is designed to capture. And it's not a certainty, obviously. It's a probability analysis. It's like the dealer at blackjack. The dealer isn't saying he thinks or she isn't thinking the next card is a 2 or the next card is an ace or a jack. What the dealer knows is the probabilities down to a small fraction of 1%. The dealer is not predicting the next card, but is acting on a knowledge of past patterns. In the market, past patterns don't replicate over and over. If they did, this would be a very easy business. Every time the pattern evolves, it evolves differently. But there's enough resemblance, for instance, in relation to the moving average here, that it can be profitably capitalized upon. You notice in the case of Netflix, whenever it touches that red line, it's a highly profitable trade. And whenever it gets to an unusually high level, it's less reliable. Here it got to a high level and it kept going up. There it's quite, it's consistently higher, and our algo would have, I should have put the trades on here, but you see in the case of, there are times like it sold part of the position. At that point, I guess it had bought 6 times, sold 2, so it was long 4. Then it had 4, so it was flat there. It bought 2, sold 2 there. But you can see that you can see that, and here it's buying in these particular cases. It did work out well, but in the sense that it was selling at fairly close to the high, or in one case right at the high. But my point is simply that it's dealing with probabilities. It's dealing with the distance between this moving average. Our algo works off very precise numbers. This moving average is very, very approximate, and but it's just here for illustration purposes. Anyway, In that discrepancy between financial performance, which one of our softwares analyzes, which is Benjamin Graham credit analysis. It's, margins and return on assets and debt trends, and then this other, capitalizing on emotion. In that discrepancy between financial performance and stock performance, opportunity lies, and that's what the software is designed to accomplish. Okay, to sum up, we don't predict the future, earnings, the economy, the market. We've run businesses, we've studied accounting, and we know how to develop software. So almost all of our work consists of comparing every public company to the thousands of others, looking for promising trends. Our software follows on a minute-by-minute basis price fluctuations in the stock prices of the 50 to 100 companies with the strongest financial statement trends, searching for inordinate opportunity. We try to express our conditions in our research in as few words as possible. You see here the conclusions: exceptionally strong growth trends, profitability trends extremely strong, average business quality, average risk, free cash flow not reliable, financial strength above average, trend particularly strong. So we try to express what we've got to say in as few words as possible, and accompany it always by graphs so that you can understand at a glance exactly what it is that what the trends are that were used to reach our conclusions. And we've designed this research in part to be complementary to the research into specific companies that you find on sites like Seeking Alpha. So we don't offer the backstory. We don't talk about management or products. There's lots of that on Seeking Alpha. We encourage our subscribers to get that kind of perspective from Seeking Alpha and other similar sites. And what we're doing is comparing each public company to all others in terms of their financial statement trends. And finally, we to close, this is our website URL, and we provide two types of research. One is inexpensive risk analysis of client portfolios and watch lists. So clients provide us with the names of the companies that they have an interest in, either because they own them or are considering them. And we give them 12-page reports, or provide 12-page reports on each of those companies. And finally, we publish SuperGrowth MultiBaggers, a research report about companies with particularly strong growth and financial statement trends. Okay, that's it. Thanks for listening and your interest in the research. And please leave any comments, questions. I'll get back to you with responses. So questions, comments below, and please click on like if you enjoyed this video, and click subscribe in order to keep aware of future videos. We're planning to do one a day. We're hoping to do them before the market opens each day, although sometimes other research prevents that. It's our objective. Okay, well, thank you again.